Hi, welcome to the June 2025 edition of Knowledge Shop's monthly tax roundup. This month, the High Court has granted the Commissioner of Taxation special leave to appeal the Bendel decision, which challenged the ATO's long-standing views on unpaid present entitlements. We'll keep you updated as this matter progresses. Also in this roundup, we'll take a look at a recent case looking at whether non-cash benefits provided to directors can give rise to a fringe benefits tax liability. And finally, we'll unpack how the luxury car tax threshold interacts with the car depreciation limit and highlight some of the common issues when assessing whether the car limit applies.
Yeah, the case that we're looking at this month is the Commissioner of Taxation and SCPL Proprietary Limited as trustee for a trust. And this is actually a case that had been looked at earlier by the Administrative Appeals Tribunal. And this was effectively the Commissioner appealing that earlier decision. It's an interesting case because it deals with basically the fundamental question, really, of determining the scope of the FBT rules, where particularly benefits are provided to someone, and we're trying to figure out whether those benefits actually fall within the scope of the FBT system or not. Now, the rough facts of the case are basically that this company was acting as corporate trustee of a trust, and that trust had a number of different commercial activities going on, a number of different kind of business activities. The three main players when it comes to those commercial activities were three brothers. And those three brothers were directors and shareholders of the corporate trustee, and they were part of a broad group of beneficiaries of the trust as well. Now, those brothers were pretty heavily involved in the operation of the business, but they did not receive any cash salary or wages for the work that they were performing. The way that they were, I guess, effectively remunerated, how they got their income, was that the trust that was running the business effectively made distributions to a range of beneficiaries, including three family trusts that were controlled by each of the three brothers. Now, in addition to those trust distributions that flowed out to their own trusts, these brothers had access to and use of some high performance and luxury motor vehicles. The trust held over 40 of these vehicles, and the brothers were able to use these vehicles for their exclusive use, and they used it partly in connection with business activities, but partly also for private purposes. Now, the issue that came up was, did the use of these vehicles constitute a fringe benefit that could effectively be taxed in the hands of the employer under the FBT system? Now, when this initially went before the AAT found that these brothers were not employees of the trust or the corporate trustee under general principles. As a result, this benefit that was provided to them in terms of the use of these vehicles, didn't fall within the scope of the FBT rules. The AAT was convinced, or satisfied anyway, that this benefit that had been provided to them, the ability to use these vehicles, was provided to the brothers in their capacity as beneficiaries of the trust, not in their capacity as employees. Well, the Commissioner appealed the decision, and this went to the Federal Court, and the Federal Court actually flipped the decision on its head. So the short answer was the Federal Court found that these brothers were indeed employees for FBT purposes, and the provision of these vehicles, the ability for them to use these vehicles, could fall within the scope of the FBT rules because that benefit was provided in respect of employment. Now, one of the key things that the Federal Court pointed out was that the AAT actually got it wrong in terms of figuring out whether these brothers were employees or not. The AAT had looked at whether they were employees under general principles or ordinary concepts. And there's significant case law in terms of how we determine that. What the Federal Court pointed out, though, however, is that that's actually not all that relevant when it comes to this particular scenario. And the reason for that is that within the FBT rules, we have very specific provisions and very specific definitions which tell us when someone is treated as an employee for FBT purposes. Now, of most relevance here is a little provision in the FBT Act which basically says, and I'm paraphrasing here, that someone can be deemed an employee for FBT purposes even if they don't receive any cash salary or wages or director's fees, but they receive some other type of benefit, for example, a non-cash benefit, and if that benefit had been provided to them in cash form, then it would be classified as salary or wages. So what that does is it means that someone who is not receiving any cash payments for the work they are performing could still be treated as an employee for FBT purposes if they receive other benefits that effectively represent remuneration for the work they're performing. Now, in this case, the brothers were all directors of the corporate trustee. Directors can certainly be treated as if they are employees for FBT purposes. And then the issue became then, well, if they weren't receiving any cash payments for their work, could they still be employees? The federal court said yes, they could. They were receiving other benefits. They were receiving the benefit of the use of these vehicles. The benefit was being provided to them effectively as remuneration for the work that they were performing. Therefore, this was a benefit that could fall within the scope of the FBT rules. Now, this is a really fundamental issue because if you're not an employee or you're not receiving benefits in connection with or in respect to employment, then we don't really have an FBT problem to deal with in most cases. But in this case, the federal court is pointing out that we do need to look at situations like this very carefully. Where you do receive some benefits, even though they're not paid in cash, you could still be deemed an employee for FBT purposes. The final probably key point that comes out of that case is that the federal court also indicated that the AAT probably didn't approach things quite right in terms of linking the benefit with employment. The AAT focused more on subjective intention, what the parties believed or said that they believed was going on. The federal court said that this really needs objective analysis. What do the facts tell us? In this case, the facts were these people were directors, they were heavily involved in the business, they weren't remunerated through cash, but they were receiving other benefits that effectively were provided to them in connection with the work they were doing. Therefore, we had an FBT problem.
Thanks, Mike. It seems like this is a common problem area. What are some of the other practical things we should be considering in situations like this?
And this is an issue that actually crops up quite a lot in practice, particularly when we're dealing with closely held or private groups. For example, it's not uncommon for someone who's operating a business through a company to be a shareholder of that company or maybe hold the shares indirectly. They might be a director and they might also be an employee as well. As with the case we've just looked at, with a trust. You could be a beneficiary or a potential beneficiary of the trust. You could also be an employee or maybe a director or shareholder of a trustee company. So where clients are receiving benefits and they wear multiple hats when it comes to the entity or the business that we're looking at, the first thing we really need to consider is in what capacity are they receiving that benefit? Now, this isn't the first time this issue has come up. It has come up in cases before, and it's something the ATO has also looked at. You might be interested to have a look at MT 2019, which actually looks at this, particularly in the context of companies and shareholders and directors. The ATO also released a while back a draft determination back in 94 that was never finalised, but it does cover similar ground. How do we determine whether a benefit is provided to someone in their capacity as an employee or director, as opposed to a benefit provided to someone in their capacity as a shareholder or a beneficiary? And really, it will always depend on the facts. Now, when it comes to that issue and kind of where that leads us, well, there are kind of two major pathways it's going to take us down. If we confirm that a benefit is provided to someone in their capacity as an employee or a director, then we will have to consider possible FBT implications. Now, there may not be an FBT exposure because there might be some exemptions that can apply, or maybe we can apply the otherwise deductible rule to eliminate any FBT liability. Clearly, it will depend on the facts, but FBT is certainly one of the things we'll be looking at. But where you have benefits being provided to someone in their capacity as an employee, what it tends to do is open up, the possibility of more easily being able to claim a deduction for the expenses associated with providing that benefit, and also providing maybe a higher chance of claiming GST credits for those expenses as well. Now, the one you need to be on the lookout for, however, is where a company or a trust is basically providing accommodation to an employee or director. While there might be scope to claim deductions for some of the expenses, particularly if there is that strong connection with business activities, much more difficult to claim GST credits in that case. And that's because provision of residential accommodation would typically be treated as an input tax supply, and that means that you normally can't claim GST credits against that income. But again, it depends on the situation. So that's what happens when we're down that pathway of someone being in receipt of a benefit in their capacity as an employee or director. Now, if we go the other way, if we're confident that the benefit has nothing to do with employment, it's not provided in connection with or in relation to an employment arrangement or deemed employment arrangement, then we look at things a little bit differently because we probably don't have an FBT issue to deal with. If we're dealing with a private company, however, we might have a Division 7A issue. Some of you would be aware that when a private company holds an asset, either owns or leases an asset and allows a shareholder or their associate to use that asset, that can be deemed a payment for Division 7A purposes. We could end up with a deemed unfranked dividend, subject to certain exceptions that might be available. If we're dealing with a trust, Division 7A is probably less likely, although if we have unpaid present entitlements owed to corporate beneficiaries, we would certainly need to give that some thought. But what it also does is it probably makes it a little bit harder to claim deductions for expenses relating to that item or that benefit, and also makes it more difficult to claim GST credits as well. Now, one exception to that would be where, for example, might be a vehicle that's involved, where that vehicle is being used by a related party, but they're actually paying some sort of fee for the right to use that vehicle. Now, depending on whether that fee is charged at market rates or not, that will impact on the tax impact for the entity providing the benefit. Can we get full deductions for expenses, or are we limited in the deductions that we can claim, maybe to the income that's being generated from the use of that asset? So it's a really fundamental thing we need to consider. In what capacity is that person receiving that benefit? As an employee or director, it will push us down one path. We might have an FBT problem, a little bit easier to claim deductions in GST credits, subject to the situation. If this benefit does not relate to employment, then unlikely we'll have an FBT problem, but we could have a Division 7A problem in some cases, and it will typically be more difficult to claim deductions and GST credits as well. So whenever we come across things like this, we always take a step back. Is this person an employee or a deemed employee? And that could include someone who's a director of a company. And is there a sufficient connection or relatively strong connection between that benefit they're getting and that employment or deemed employment relationship? That will then influence on how we approach the rest of the tax system in connection with that benefit.
Thanks, Mike. From 1st of July, new thresholds will apply for income tax, GST, and luxury car tax. And can you walk us through how these thresholds work in practice?
Thanks, Amy. So for the 2025 to 2026 financial year, the car limit is set at $69,674, and this represents the maximum value you can use to calculate depreciation on a car used for business purposes, provided the car is first used or leased within the 2026 income year. So it's important to note that for tax purposes, the car limit is effectively a GST exclusive amount. This means that even if you purchase a car above this limit, the maximum GST credit that you can claim is capped at 1/11th of the car limit, which amounts to $6,334 for this year.
Okay.
When you're determining depreciation, you start with the full GST inclusive cost of the car. You then subtract any GST credits you're entitled to claim. And if the remaining amount exceeds the car limit, then the depreciation claim is capped at the car limit. So for example, if you purchase a car for $70,000, the claimable GST is still $6,334.
Okay.
Subtracting this from the purchase price of $70,000, this gives you $63,666, which is below the car limit. So in this case, you can use the full $63,666 as the cost base for depreciation. It's also worth noting that the car limit applies only to the first element cost base of the vehicle. So any other element costs, such as delivery costs and improvements, are not impacted by the car limit. Separately, the luxury car tax threshold for the 2025 to 2026 income year is $91,387 for fuel-efficient vehicles and $80,567 for all other vehicles. The luxury car tax threshold is a separate limit to the car limit. So luxury car tax applies if you import, acquire, or sell a luxury car with a GST inclusive value above the threshold. except in certain circumstances. So the tax rate is 33% on the amounts exceeding the threshold. In general, the luxury car tax value of a car includes the value of any parts, accessories, or attachments that are also supplied or imported at the same time as the car. Fuel-efficient vehicles are also able to access a higher threshold, which may exempt them from paying luxury car tax, which provides additional savings for certain taxpayers. And from the 1st of July 2025, the definition of a fuel-efficient vehicle will also change, which affects vehicles with fuel consumption rates of 3.5 and 7 litres per 100 kilometres. And the indexation rates applying to the thresholds for fuel-efficient vehicles and other vehicles will also be aligned from the 1st of July. The fuel-efficient luxury car tax threshold is also relevant when you're looking at whether a vehicle would be exempt from FBT. Under the electric vehicle's FBT exemption, one of the criteria is that the vehicle was below the luxury car tax threshold for fuel-efficient vehicles at the time of acquisition.
And what are some of the other common issues that come up when you're looking at whether the car limit applies?
Thanks, Amy. So in order for the car limit in Section 40-230 to apply for tax depreciation purposes, the vehicle needs to be classified as a car, and it must also be designed mainly for carrying passengers. So the first step is determining whether the vehicle is a car under the legislation. So a car is defined in the legislation as a motor vehicle that's designed to carry a load of less than 1 tonne and fewer than 9 passengers. So if the vehicle that you're looking at is designed to carry a load of at least 1 tonne, then it shouldn't be classified as a car and the car limit shouldn't apply, regardless of how the vehicle is used.
Right.
However, if the vehicle that you're looking at is designed to carry a load of less than 1 tonne and fewer than 9 passengers, then you need to focus on whether it's designed mainly for carrying passengers. This is because if it's not designed mainly for carrying passengers, then the car limit shouldn't apply. So to determine whether a vehicle is designed mainly for carrying passengers, we would first look at what type of vehicle it is. If the vehicle is a dual cab ute, the ATO sets out a method in its miscellaneous tax ruling MT 2024. So while the ruling deals with the FBT system, the principles should presumably be the same here. So the ATO indicates that you can use a formula to work out how much of the carrying capacity is attributable to the passengers using 68 kilograms per seat, including the driver. So if the total passenger weight using this formula is less than the remaining load capacity, then this indicates that the vehicle is not designed for the principal purpose of carrying passengers. So using an example, a dual cab with 5 seats would have a passenger weight of 5 times 68 kilograms, which gives you 340 kilograms. This is then compared to the payload, so for example, 800 kilograms. And since it's less than half of the total payload, this means that the vehicle isn't designed mainly to carry passengers, and therefore the car limit shouldn't apply.
Okay.
As for vehicles other than dual cab utes, so for example, single cab utes and 4-wheel drives, the tax determination TD 94-19 sets out the factors that should be taken into account. So while you would still refer to the formula that's used for the dual cab utes, you also need to consider other factors such as the appearance and the presentation of the vehicle, relevant promotional literature, marketing, and the vehicle specs such as the load carrying capacity and the passenger carrying capacity. If overall the vehicle is not considered to be designed for the principal purpose of carrying passengers, then the vehicle shouldn't be subject to the car limit for depreciation and GST purposes, and the full cost can be depreciated.
That brings us to the end of the June Knowledge Shop monthly tax roundup. As always, if you're a Knowledge Shop member, you have full access to our suite of resources, including the member help desk, practical work papers and checklists, and a comprehensive range of technical tools to help you navigate complex tax, superannuation, and practice issues as they arise. If you have any follow-up questions from today's discussion, don't hesitate to get in touch via the member helpline. We're here to support you and your team with the technical challenges of day-to-day practice. And if you're not yet a member and want to learn more about how Knowledge Shop can support your team, get in touch with us. We would love to show you the tools, training, and support that our members rely on every day. Thanks for joining us, and we look forward to seeing you in the next Tax Roundup.